Hello financial fans, welcome back to another stock analysis. Today we'll be covering JP Morgan Chase stock ticker JPM. JP Morgan is a financial service company that provides a wide range of financial solutions to individuals, corporations, and governments around the world. The company's primary service includes investment banking, asset management, treasury services, commercial banking, and private banking. As an investment bank, JP Morgan helps companies raise capital by underwriting and selling stocks and bonds. The bank also provides merger and acquisition advice, as well as strategic advisory services to companies looking to expand or restructure their operations. In asset management, JP Morgan offers a variety of investment products and services, including mutual funds, exchange-traded funds, and separately managed accounts. The bank also manages alternative investment vehicles such as hedge funds, private equity funds, and real estate funds. JP Morgan's Treasury Services division provides cash management, trade finance, and custody services to corporations and financial institutions. The bank's commercial banking arm offers a variety of lending and financing options, including commercial loans, lines of credit, and equipment leasing. Lastly, JP Morgan Private Banking Division offers wealth management services to high net worth individuals and families. These services include investment management, financial planning, estate planning, and trust and estate admission. Currently, JP Morgan is sitting at a $383.6 billion market cap. In 2022, they generated a revenue of $157.5 billion, and the dividend yield is currently sitting at 3.07%. 44% of their revenue comes from corporate and investment banking, 37% from consumer and community banking, 7% from commercial banking, and 12% from asset and wealth management. To determine the final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I'll be using standard margin of safety of 25% that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT in red has gone up, going from $26.7 billion in 2012 to almost $60 billion in 2022. The average EBIT growth was 10.3%, meaning no change in the margin of safety. The margin has also gone up, going from 27.5% in 2012 to a number that is not visible, but it's above 40% currently in 2022. The average margin growth is 7.9%, meaning a 5% deduction in the margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up over the years, going from 25 cents a share in 2012 to $1 a share in 2022. The average dividend growth was 15.4%, meaning a 10% deduction in the margin of safety. This with a payout ratio that's sitting at 33%, which is no change in the margin of safety. The final metrics are the debt to EBITDA and the assets under management CAGR. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. As you can see in the top left, their cash position is currently greater than their debt position, meaning that they have no net debt. This indicates a 0% debt to EBITDA ratio, which is a 5% deduction in the margin of safety. Looking at the assets under management CAGR, we want to see this increase, which is happening currently, going from $20.5 trillion in 2017 to $33.2 trillion in 2022. The growth was a 7.2% CAGR, which is a 5% deduction in the margin of safety. Looking very good so far for JP Morgan. Let's go look at the valuation models next to determine the intrinsic value of JP Morgan. The first valuation model we'll be using is the dividend discount model. I've imported the dividend payouts going from 2018 to 2022. The average growth rate in dividends during this period was 16.62%, and I'm projecting an expected growth rate of their future dividends of 6%. I will be using a 9% discount rate in this valuation, giving us a dividend discount model price per share of $141.33, which is an 8.43% upside of this model. The second model we'll be using is Graham's revised valuation formula. In this model, we look at the earnings per share that JP Morgan is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds sitting at 4.4%. And we go by the theory that a PE of a company with no growth is always at 7, giving us a price per share of $132.88, which is almost a 2% upside from this model. The third model that we use is the multiple valuation. In this model, we look at similar companies to JP Morgan, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is 9.95. Also to get our multiple valuation price per share is to multiply it by the amount of earnings per share that JP Morgan is generating, which is $12.08 a share, giving us a price per share of $120.21, which is a 7.77% downside out of this model. The fourth model that we use is the price to tangible book value. In this model, we again look at similar companies to JP Morgan. In this case, we look at the tangible book value in relation to the shares outstanding, giving us the tangible book value per share, and then dividing it to the price. Then we get the price to tangible book value, and on average for these three companies it is sitting at 1.35. Doing the same for JP Morgan, we get a price to tangible book value of 1.88. This gives us a price per share of $93.57, which is a 28.21% downside of this model. And the last model that we use is the cost to income ratio. In this model we again look at the same companies as in the prior models, and we go look at the cost to income ratio, so the income expenses to the income or out of interest. This gives up the cost to income ratio, and on average this is sitting at 33.47%. And this ratio for JP Morgan is sitting at 28.12%, indicating that it's undervalued. This gives us a price per share of $155.15, which is a 19% upside out of this model. If you want access to all of the models that I use in my videos and more, you can check in the description for my Patreon link. Anyways, getting that out of the way, let's go look at the final overview of our valuation next. Looking at a final overview, we've imported the discounted dividend, the Graham's valuation, the multiple valuation, the price to tangible book value, and the cost to income ratio. On average, this gives us a price per share of $128.63. A margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting it by 5% for the margin growth, 10% for the dividend growth, 5% for the debt to EBITDA, and 5% for the assets under management category, leaving us with no margin of safety at all. With this fair value then, with the current price of $130.34, we get a small downside of 1.31%, meaning that it's trading very close to fair value at the moment. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.